Good afternoon, everyone, and welcome to Scotia iTrade's webinars. Today's topic is on understanding the Greeks with the Montreal Exchange. Let's do a quick audio test before we get started. If you can hear me clearly and the sound quality is great on your end, please click on the hand icon in the control panel. Thank you, Caroline. Gloria, thank you. And if you are experiencing audio difficulties, please click on that sound check link in your audio panel. Sometimes the link may say settings as well. And the setup window may show up on your secondary screen if you are using two monitors. And as always, everyone is muted for sound quality purposes. Also, if you did join using your computer speakers and you find that the audio quality is not great, you're also welcome to dial using your telephone. Don't forget to enter the access code as well as the audio PIN ID. And just as a reminder that Scotia iTrade does not provide investment or tax advice or recommendations, and nothing in this presentation is or should be construed as investment or tax advice or recommendation to buy, sell, or hold any security or to follow any particular investment strategy. Today's presentation, as with all of our presentation, is strictly for educational purposes only. And we did get a chance to use this control panel right here. I just want to note that the GoToWebinar platform sometimes automatically hides the control panel on you. And if you find that that is the case and you want to make it visible, you can always click on that arrow icon. And you're also welcome to view in full screen mode. And as always, you can click on the hand icon should you have any questions. And you can always type in your questions in the question panel, and our presenter will address them either as they come in or at the end of the session. And we are recording today's session, and if you did select yes on the registration page, we will email you the recording. Alternatively, you can access our past webinar recordings on our Webinars on Demand page, or also request to get a copy of the recording link by sending us an email to education@scotiaitrade.com. And you are also welcome to take notes. However, I will make today's presentation available for you to download at the end of the session. I do want to note that the handouts panel is not visible until the end of the session. And today's webinar is part of a learning series that Montreal Exchange offers. And Understanding the Greeks is part of Series 3, Mastering Options. If you find that you do want to follow this series, this learning series, you can view the past sessions under the Webinars on Demand section. And our presenter today is Jason Ayers. He's been an instructor for the Montreal Exchange for several years and actively advocates and educates investors on the practical utilization of options for managing risk, cash flow, and leverage. In addition to the development of numerous strategic relationships with some of the most prominent brokerages and exchanges in North America, Jason is the president of Learn to Trade Global, as well as founder of OptionSource.net. He is a derivative market specialist by designation. Welcome, Jason.
Hey there, Rose. Thanks very much. Appreciate the opportunity to be here today. So we're just going to move forward here, and I'm going to share ideally my screen, so perhaps just another test of that hand to make sure that everybody can indeed see what they're supposed to be seeing, which would be today's title slide. Perfect. Good stuff. All right, so we'll get right down to it. As Rose mentioned, what we want to take a look at is options pricing. And we're going to dig a little bit deeper into understanding the Greeks. Now, once again, to echo Rose's sentiments with respect to today's presentation, we just want to make sure that everybody understands that this information is for educational purposes only, and the options market, unlike any financial market, does have its risks associated with it. So just make sure that you understand those risks before you move forward and start trading for yourself. So we have a lot to cover, but really in the context of a few key topics here. We want to first take a look at how an option price is determined, just to give everybody a little better understanding in terms of how the market determines the option price and how the different influences act on the premium as we see them posted in the options chain. We want to dig a little bit deeper into understanding the variables in options pricing, and then we're going to take a look at options Greeks. So first of all, when it comes to understanding how an option price is determined, I think it's really, really important for everybody to understand that at the end of the day, options are priced based on probabilities. right? So that's really what we're dealing with is, the value of an option contract is essentially based on the market's expectation as to whether or not the stock is going to be above or below a particular strike price within the time frame allocated to that contract. These probabilities are calculated using different pricing formulas, but the most common and well-known is the Black-Scholes pricing model. So the different pricing variables, or more specifically the option Greeks that we're going to talk about here today, are in fact plugged into this Black-Scholes pricing model, which is a rather large and complex equation, and the result is what's referred to as a theoretical value. So it's the theoretical value of that option contract that market makers will use in order to set the price, and then of course they'll post a bid and an ask based on that theoretical value, and then of course market forces will influence the prices higher or lower. So when we look at the key variables in deciding how an option price is going to be posted, the first consideration is the price of the underlying security. So that's a very important consideration. I always like to suggest that investors should first and foremost have a good understanding of what is happening with the underlying security first, before they actually look at determining what might be the best option strategy or what might be the best strike price or expiration date, because that price of the underlying security and the fluctuation in value is what is going to be, at the end of it all, really determining the value of the contract. Now, the strike price of the option contract and its relationship to the underlying will also have an influence. So, for example, an in-the-money option, which would be an option contract that has intrinsic value, we've talked about that in previous webinars, will be priced higher than an at-the-money option contract. And then subsequently an out-of-the-money option contract will be cheaper. And so as the stock price moves up and down, its relationship to the strike price of the option contract will be influencing the price of the contract. Time until expiration, very important consideration that quite often many investors, as they start out trying to embrace the options market, don't understand all that well. But one thing we have to recognize is that time is always acting as an influence on the option contract, and on a day-to-day basis, the value of an option contract, or the time value of the option contract, is depleting, which means that the other variables need to actually kick in and help offset that. So time works in the favor of the option writer, so covered call strategist, or somebody who is selling a credit spread, for example, or selling a put option. The main strategy behind the option writing approach is to take advantage of the depreciation of the time value, whereas if we're the option buyer, we have to recognize that from the day at which we buy the contract, the value of that particular contract will be depreciating, and we need to manage accordingly. Volatility is another consideration. We in fact have a presentation that deals exclusively with volatility and the difference between historic and implied volatility. Very important to understand that this is a key pricing variable that is quite often misunderstood. So that's something that I think if you guys are looking at different webinars to circle back to review some of the content, definitely take a look at the volatility one, because most often overlooked and misunderstood pricing variable that hopefully we'll be able to help you guys with a little bit today. Finally, dividends and interest rates are factored in as well. So those are your 6 main key pricing variables that are added into the Black-Scholes model, or used within the Black-Scholes model to determine what the theoretical value of an option contract might be. So to break each one of these down a little bit more, again, the price of the price of the underlying security and its influence on the option contract is probably the simplest variable to understand. As the price of the stock increases or decreases, the option will change in value, right? So that in and of itself obviously is a very important consideration, as I mentioned, because when we're looking to choose an appropriate strategy, or when we're looking to choose an appropriate strike price or expiration date, a lot of that decision-making process has to do with the trading characteristics of the underlying security. Once again, the strike price is the price at which the option is exercisable. So depending upon how far away the underlying security's price is from the strike, the market assigns a certain level of probability as to whether or not that option on expiration will be in the money and then subsequently exercisable. So the closer the stock is to the strike, the higher the option value, simply because the probabilities are that much greater that that contract will have a value on expiration. Now, time, again, the simplest way to understand this is the more time until expiration, the more expensive the option contract. And as we get closer to the expiration date, we continue to lose the time value component, which means that the other variables, as I suggested, need to kick in and help offset that if you're somebody who's purchased the option contract as part of your strategy. Volatility, again, in general, the more volatile a stock is, the more expensive the premium will be. And this is actually to reflect the risk of a sudden and rapid price change. Again, it's really just a function of predictability, or probably more importantly, unpredictability. If we think about it like how car insurance is priced, and you guys have probably heard me use this analogy in the past, but you know, if you are somebody who has had a long and safe driving record, and you've never gotten into an accident, never gotten into any speeding tickets, then you would fall within a category of reasonable, as being a reasonably safe and predictable driver, and subsequently your car insurance will be reflective of that. Whereas, if you're somebody that's driving a high-powered sports car, and maybe you've ran a red light or two, and or a stop sign, or pulled over for speeding, well, even though you haven't gotten into an accident, the car insurance underwriter, or the insurance company, is going to say, well, you are unpredictable and you are exhibiting behavior which suggests that you might be a little unsafe, and as a result, your insurance premium is going to be higher. So that's how volatility influences an option contract in relationship to the way the stock trades. So a stock that has significant price swings, on a day-to-day basis, and can move quite a bit, will have an option contract that is priced higher than a stock of the same value, but maybe is less volatile. Dividends are already priced into the option contract, so all known dividends are discounted from the price of the contract. Again, which means that it is, if you're looking at an option contract that has an expiration date, 4 months from now, and if there happens to be a dividend planned for distribution within that time frame, then that actually will be factored in to the premium as well. So, so important consideration that the option holder, so it's only the shareholder that receives the dividend. If you own a call option as a stock replacement strategy, you do not receive that dividend. It's only the person who owns the underlying shares that would receive that dividend, and that particular dividend adjustment is already priced into the contract. And finally, interest rates. So, not something that obviously is changing significantly all that much, but the risk-free rate of interest is also factored into the price of an option contract. So all of these variables have in fact been assigned what are referred to as option Greeks. So it's one thing to sort of understand in general the different pricing variables, but we got to understand that we're dealing with derivatives, and derivatives, of course, are all about mathematics. And so these variables are all actually represented by specific numbers that are assigned specific Greek names. So option Greeks essentially measure the change in value of an option contract due to a change in one of the pricing variables. So, as time adjusts, as volatility adjusts, as interest rates adjust, as the relationship between the stock price and the strike price adjusts, there has to be some sort of a number that is exacting some sort of an influence on the value of the premium. So, again, with the Black-Scholes model being a mathematical model, a number has to be plugged into that model representing these different pricing variables. So as professional traders and market makers, these option Greeks are used to create hedged positions. So, for example, you can manipulate the exposure of a portfolio by understanding the net delta of that portfolio, which we're going to talk about in a few moments. Or you can understand how a portfolio is going to respond to different moves within the market by being able to assign specific values to the influencing factors. As retail investors, we can actually use the option Greeks to understand how a change in one of the variables will influence the option price, and this, in fact, will help us be more effective at choosing the appropriate strategy for a particular market environment, or subsequently being able to manage our expectations with a position. So, for example, if I buy a call option and the stock goes up, that position is going to actually perform differently than if I buy a call option and then sell a call option as part of a bull call spread. So we need to understand that when we start combining positions, combining contracts, we are influencing the mathematics of the position, and then when the market moves, we're going to see different results, again, dependent upon what contracts we've been using or we are using and how we're using them. So there are actually 5 variables here that are used mathematically as an input within the Black-Scholes model. And so again, these are the values that are all assigned Greek names. So we have the delta, the gamma, the vega, the theta, and the rho, right? So each one of these variables has its own unique influence on the underlying value of the option contract. And so as each one of these variables is changing, the option contract is adjusting accordingly. And that's why if you've ever been watching options trade throughout the day, you may see prices adjusting minute by minute, second by second, but those adjustments may not necessarily correlate with what you're seeing in the underlying security, because that movement in the underlying security is just one variable that is exerting an influence on that price. And so you've got to understand that just because the stock goes up $1 doesn't mean that the option contract is going to go up $1, because there are other variables that may be adjusting within that same time frame that are either supporting and in fact influencing that adjustment higher, or maybe mitigating or limiting the influence of that adjustment as well. So these are things that, as you become more comfortable with the options market, you'll be able to use to your advantage when managing your positions or choosing different strategies. So I always think, one of the most important option Greeks is the options delta, and the delta is basically a mathematical measure used to show the change in an option price relative to a change in the price of the underlying security. So we recognize that just because the stock goes up by $1, the option contract may only go up by 20 cents, or the option contract may only go up by 50 cents. You're never, you can try to achieve a dollar for dollar, relationship between your option contract and the movement in the underlying shares, but in order to achieve that, you have to choose the appropriate option contract with a delta that is comparable to that of what's happening with the underlying security. So to understand this a little bit more effectively, if we took a stock that had a price of $50 and we looked similarly at an option strike price of $50 with 30 days until expiration, that call option price may be listed at $2.32. Well, that call option with these different specifications has a delta of 0.53. In fact, any at-the-money option contract, it doesn't matter how expensive the stock is typically going to be close to that 0.53. And what that essentially is telling us is that for every $1 move in the underlying security, the option contract is going to move in value 53 cents. So in other words, all things considered, if the stock goes up $1, the call option contract should increase by its delta. So for example, if the stock goes up to $51 and the strike price is 50, the option price would adjust higher to $2.85. We add the 53 cents to the $2.32. If the stock price goes lower by $1, well, then that adjustment takes place on the downside. So if the stock drops from 50 to 49, then the delta, given that $1 move lower, would influence the premium lower, and you would have a contract worth $1.79. Right, so we want to recognize that as the stock is moving up or down, which is something that we were referencing in our earlier slides, you know, by $1, by 50 cents, by 20 cents, whatever it is, that movement is being reflected in the option contract by the rate of its delta, right? So the other thing that we can do by understanding the you know, the delta and how it's related to the an underlying stock position is, let's take a look at the XIU, and let's just assume it's trading at $20 per share. Now, if we looked at a 1-month $20 call option with a delta of 0.50, and we compared a couple of positions, if we had 1,000 shares of the XIU, the notional position size would be 20,000. Essentially. And so that means we've got a delta exposure of 20,000. So if we in fact bought 10 1-month $20 calls, again with a delta of 50, the notional position size would be 20,000, right? But our delta exposure would only be $10,000. If we bought 20 1-month $20 calls, the notional position size would be 40,000, but we'd have a delta exposure of 20,000. So that delta is essentially, really all we're doing is multiplying the notional size reflected in the number of contracts we have. So 10 contracts times, you know, 100 shares per contract times the $20 strike price, you know, reflects the notional position size. But then when we multiply that by the delta, that is reflecting the actual exposure that we have for the underlying security, and that kind of information is being utilized by market makers to calculate the you know, the net exposure of their portfolio to you know, to the market, and then subsequently they can manage their exposure and risk from there. So a couple of things to recognize here: as a call option becomes deeper in the money, the delta will approach 1. So if you were trying to create a position utilizing options where you were more closely reflecting a position in the underlying stock, then you would choose a deep in the money option contract with a really high delta. Ravi's just asking just what do we mean by notional? Notional sort of means imaginary. So it's not, you know, you don't really hold the position. You're not holding the actual position, you know, reflected by that by the number of calls, but you have an exposure. So you have an exposure reflected by your call position, but you know, owning the 1,000 shares would be the real position. Owning 10 call options with your right to buy the shares at $20 is what we're referring to as being the notional position. So it's sort of reflecting a comparison to the you know, to owning the underlying security. So just an important consideration here: call options always have a positive delta, and you know, so we can use this if we're, you know, if we're short a stock position and we wanted to hedge using using call options. So we would be short stock, which would have a delta of -1, and then we would be long a call option, which would have a positive delta of whatever the contract is reflecting at that time. So that way, our -1 delta exposure for the short stock is offset by the positive 0.50 delta of the long call, and as a result, you're able to calculate your net short exposure. Now, as a put option becomes deeper in the money, the delta will approach -1. Now, this is a little bit easier to understand because when we buy stock, if we own shares of XIU and XIU goes up $1, well, we make $1, so that's reflecting a delta of 1. So when we're trying to build hedges into our portfolio, we can actually calculate our risk exposure by recognizing that your long stock position has a positive delta of 1, and then let's say we bought one put option with a delta of -0.50. Well, what that means is that your actual exposure to the risk in the underlying security has been cut in half. So in other words, your -0.50 put option, if you subtract that from your +1 delta of the stock, means that your net exposure to the underlying security is 0.50. So put options always have a negative delta, and again, for portfolio hedging or for determining sort of market exposure to the underlying security, that negative and positive makes the difference in how things calculate out. Now, again, just to reinforce this understanding, a delta of 1 means the option price will increase $1 for every $1 increase in the underlying security. So if we look at a delta of 0.45, really what that's suggesting is that the option price will increase 45 cents for every $1 increase in the underlying stock. So again, a lot of times one of the questions that come up, or more so a complaint more than a question, is, I bought a call option on stock XYZ, and stock went up $3, but I only made $1. What's going on? Well, it's simply because the exposure that you had with the call option is reflecting the movement is reflecting the delta versus holding the underlying security, where that movement is reflecting its delta of 1. So again, when it comes to managing expectations, just even simply understanding the options delta helps you recognize where the disconnect is. Remember that options are derivatives, so the options contract derives its value from a movement in the underlying security. If you want to take advantage of a movement that reflects that of the underlying security exactly, then you got to buy the underlying security, or you've got to create an options position with an understanding of the deltas to reflect that +1 delta, which is again the delta associated with owning the long stock. So again, long stock has a positive delta of 1, short stock has a negative delta of 1, and that's always constant. And then our combinations of option contracts will then determine what our net exposure is. So I talked about the idea that an out of the money option has a low delta. At the money options usually sit around 0.50, and in the money options approach 1. Well, we know that stocks are moving throughout the day, consistently influencing the value of the option contract. So the question becomes, how does an option with a delta of 0.50 ultimately end up with a delta of 0.80 or a delta of 0.99? Well, the influence on the delta is referred to as the gamma. So the gamma is the rate of change in the delta. It's the second derivative. So it's basically the delta of the delta. This is where things get a little bit more complex. So we're not going to get much more complex than this. But just understand that gamma is influencing the delta. right? So as the stock moves higher, for example, and the option contract, benefits from that 50-cent increase if it has a delta of 0.50. Well, also what's happening is the gamma might be a 0.10. So as the stock goes up $1 and the option contract goes up by its delta, then the delta will be influenced by the gamma, and the delta may go from 0.50 to 0.60 or whatever it is that the delta happens to be, that the gamma happens to be at that particular time. So what happens, and what's interesting, and this actually has a significant influence on why some speculators will choose week-long options. So we all understand that in Canada we have access to weekly options, and of course in the US as well, on stocks. Well, one interesting consideration for those of you that are more shorter-term traders is that when we're dealing with options with a short time frame, those contracts have a really, really high gamma sensitivity. So what that means is that a small move in the underlying security will influence the gamma more significantly within the last week of the life cycle, which then subsequently will influence the delta more significantly. So if you have a short-term outlook on the stock, you could really get significant bang for your buck in the last week on a good move or a significant move in the underlying security. Again, also plays an important factor for professional traders who are using options to delta hedge their portfolios, as well as market makers trying to achieve a delta neutral exposure, because what they can actually mathematically determine, and this is all done through computer software, is that they know that if the stock moves a certain amount, that the gamma is going to influence the delta is going to influence the risk exposure, and then so they can be calculating just how positions need to be adjusted as the stock continues to move, so that they can maintain a what's referred to as a delta neutral exposure. So just to kind of reference what I mean by delta neutral, if we go back to some of our earlier webinars, we've talked about market makers in the past. Market makers' job is essentially to provide liquidity in the absence of public orders. So in other words, if I put an order in for an option contract and nobody else has an offsetting order, so if I want to buy and nobody wants to sell, that market maker has to sell to me. So they become the buyer for every seller and the seller for every buyer. Well, the risk there, of course, is that they're taking on market positions that expose them to risk. So, for example, if everybody wanted to buy puts because they thought the market was bearish, the market maker would be selling puts, which is essentially a bullish exposure. And so the market maker only makes money on the spread between the bid and the ask. So the job of the market maker is, if I want to sell an option contract as part of a covered call strategy, the market maker, if there's a bid of 50 cents and an ask of 60 cents, the market maker's objective is to buy that call from me at 50 cents and then turn around and sell, collecting that spread. So they're making a small amount of money, but what they've done is they've assumed a position in the underlying security. And so delta neutral means if they add up the delta exposure of the portfolio and it's +1, then they need to bring in other options positions or even other stock positions that has a negative influence. So the idea is that if all the stock positions add up to a delta of 1, then they need to bring in enough options positions to add up to a delta of -1, and as a result you have a delta neutral portfolio. But recognize that as stock positions move, the delta exposure changes, and so the market makers have to be constantly in a position of adjustment, and that's where the gamma also helps them make that determination as well. Stuff we don't necessarily have to worry about so much on our end, but still very important to understand what's going on behind the scenes. Now, Vega represents volatility. So Vega is a measure of change in an option price relative to a 1% change in implied volatility. Remember, implied volatility is the a component of the option premium that is reflecting risk, so it will expand and contract. And Vega is not bound to 0 to 1 range like the other Greeks. So in other words, the delta, for example, of an option contract can never be above 1. You could generate a greater than 1 delta exposure by buying 2 option contracts that add up to a higher delta of 1, but basically the individual delta of a single option contract cannot be greater than 1. But for Vega, it's not bound to that range. And it's always in a constant state of expansion and contraction, which is influencing the underlying security. Again, I'll recommend that you go back and watch our video on understanding volatility, because it's a very, very important consideration when you're looking at strategy selection. Vega will always be higher on higher priced options. So in other words, the reason why the option price is higher typically is simply because, and this goes back to what I was saying at the beginning, where a stock that has that is highly volatile will have a much higher Vega, simply because that is reflecting the risk associated with the move, with the quick and rapid movement of the underlying price action. So the Vega will always be higher on higher priced options. So again, and this is a bit of a review for some of you, but when we look at expanding implied volatility, we want to recognize that market conditions change, right? So market conditions go, from being risky to less risky. And what happens is when we move into a more risky environment, this forces the volatility of the option contract to expand, adjusting the underlying price, right? Again, it's like you've been driving along and you've had no speeding tickets and gotten no accidents, but as soon as you actually something happens, all of a sudden your insurance company catches wind of it and they increase your premiums. Well, that's what happens to an option contract. If there is an expectation that a stock or the market in general is going to be unpredictable, then option premiums will adjust accordingly, and they will become more expensive. The rate of change, or the unit of measure that is used to track and calculate this rate of change, is known as the Vega. So Vega reflects volatility. So we go back to looking at a chart that is reflecting a expanding implied volatility. So understand that under normal circumstances, a market maker would be looking at a stock and they would say, okay, there's a high probability, 68.4% probability that the stock is going to remain between $27 and $33, if it's currently trading at 30. And so they will price all the option contracts accordingly to that. And this is what's referred to as a distribution curve. But what happens is, as market conditions change, they will actually have to tack on a higher probability. So what happens is, while the original range suggested the probability of the stock remaining between 27 and 33 was relatively high, it then widens out to 25 to 35, and then all the option contracts need to be adjusted accordingly, which means that if we're buying options under those circumstances, we're actually buying options at maybe a higher price, right? So the ideal scenario would be to buy the options now, right, when implied volatility is low, because if we actually own the contract when we see this expansion of implied volatility, right, what happens is the option contracts that we've purchased, even though the underlying shares have not increased in value, we've just benefited from that expansion of implied volatility, right? So that's one of the things that we need to be keeping in mind, and that increase, that nominal increase, is based on what the vega of the contract is at the time. So as you can see here with this chart, what's happening, just to circle back, is we start with a option being priced based on the stock kind of doing what it's always done. Then all of a sudden something changes, and the market maker needs to make that adjustment, needs to widen out that probability, and now it's a probability between 26 and 34. And again, we're going to be paying that premium. So when market conditions change and risk is being considered as being a little higher, you get the expansion. But what happens is we also can see an environment where we see a change, a period of less volatility, right? So think about implied volatility leading into the elections versus now, once the elections are over and everybody knows the outcome, what would happen to implied volatility. So ultimately what happens is implied volatility contracts, and that adjusts the price of the options. And again, as the vega shrinks, that then is lowers the premium. So once again, to circle back to this this distribution probabilities distribution curve here, under normal circumstances, the expectation is that the stock's going to trade within a certain range. What happens is when implied volatility contracts, the probability decreases, and so it's anticipated, that the stock is going to remain within a tighter range, and so option contract prices are adjusted accordingly, right? And so it's important to recognize that if we are the buyer of an option contract when implied volatility is high, in the absence of everything else, if we get a contraction of implied volatility, we could lose money. Similarly, if we buy when implied volatility is low and we get an expansion, well, that expansion manifests as an increase in the option price, and that influence is by way of the vega. So to give you an example of how this would work, right? Let's look at it at a stock price trading at $50. Once again, strike price 50. All things considered, 30 days until expiration. We got an option price at $2.06. Implied volatility might be sitting at 35%, and the option contract has a vega of 0.57. 0.057. So what this is telling us is that for every 1% move in the underlying, 1% move in implied volatility, our premium will lose or gain 5 cents, and that could be substantial, right? So I mean, one of the things that happens is that, let's say for example you buy a call option ahead of an earnings report, and you pay $1 for that call option, and implied volatility is really high. Well, if the stock goes up $1, technically that option contract should be maybe worth $1.50. If you've got a call option with a delta of 50, stock goes up $1, that option should be worth $1.50. But if the stock goes up $1 and the option contract is adjusted by $1.50 because of the delta, but implied volatility contracts by 10%, that is a 50-cent hit. If you've got a vega of 0.05, that's a 50-cent hit to the premium. So in other words, you've had a stock that's gone higher, and you were right about the directional bias, but because you suffered a significant contraction of implied volatility, even though you were right about the movement of the underlying security, you forgot to consider the contraction of volatility, and as a result, you didn't make any money. So you're right about the stock, but you didn't make money on the option contract. A lot of times when investors don't understand that this is what's happening, they think that the market is rigged and that they're the market's out to get them. But really, it's just a function of understanding how these variables work and when to be buying the contracts and what to be looking for. So to carry on with this example, if implied volatility goes up by 1%, then the premium here that's worth $2.06 would actually be worth, rounded up, $2.12. Well, that's a pretty decent kicker to the upside without having the stock needing the stock to do anything. But conversely, if implied volatility drops by 1%, with that same Vega, you'll go from from $2.06 down to $2. So you're talking about a 3% haircut on the premium just because implied volatility dropped by 1%. And that's where you can get into trouble around earnings reports if you're not careful, because leading into earnings reports, quite often implied volatility expands significantly to factor in the unpredictability. And then once the earnings report is released, all known information is factored in, and implied volatility contracts, and that's that. You get hit on that contraction. So very, very important consideration. Vega only influences time value, not intrinsic value, right? So what you want to recognize is that at the money options have the highest Vega influence. If you go deep in the money, or if you go way out of the money, there's not quite as significant of influence on the underlying contract, right? So just important when you're in the process of contract selection. Now, theta is the other one, the other consideration or pricing variable that's quite often overlooked. Theta is the measure of change in an option price relative to a change in the time until expiration. So really, the bottom line is every day that passes, an option loses time value. So theta measures that rate of time decay. So if we take a look at that as an example, again, all things considered, option price at $2.06, we got 30 days until expiration, and let's say we've got a theta of negative 0.041. Understand that theta is always going to be negative. As the buyer, that negative theta works against you. As the seller, that negative theta works in your favor. But if we see a time depreciate by 1 day, then you're going to see the option contract appreciate by the rate of its theta, which in this case is 0.041 or 4 cents. So that option contract that was priced $2.06 yesterday, all things remaining the same, would be priced at $2.02 today. So very, very, very important consideration as the option buyer to make sure that you are managing for that time depreciation factor. Make sure that you give yourself time to be right about the movement you're anticipating, and don't be shy to close the position early if targets have been met, because every day that you hold on to a position, even though the stock's moved in your favor, it's slowly, your profits are slowly eroding. So quite often, if you get that move, really fast move in a very short period of time, you're better to take the position early then hold on for another 2 months and run the risk that the stock's going to just sort of drift along and not really do too much, and you're just going to get subjected to time depreciation. Theta again only influences time value, no surprise, not intrinsic value. Very, very important consideration. If we're looking to try to offset the impact of time when we're buying an option contract, the deeper in the money we purchase the contract, the more intrinsic value and the less time value. So one consideration is that time value is highest at the money, right? So that's where you're going to pay the highest in time value. But if you're right about the direction of the underlying security and the stock starts to move in your favor, the more intrinsic value, so as that option becomes in the money, the more intrinsic value that is being generated through the movement of the underlying stock, the less the time value will be influencing the position. So again, if you want to mitigate the impact of time, you can buy a deep in the money option contract, and typically it has a higher delta, which may be a positive thing, but it'll also have a lower time value component to it as well, so you can offset that theta influence. Rho is the adjustment for interest rates. Rho is the measure of change in the option price relative to the change in risk-free rate of interest. Again, mathematics are very simple. Stock price remains the same. Strike price is 50 at the money. Time till expiration is 30 days. Option price is $2.06. If the interest rates are at 3%, we might be sitting with a Rho of 0.02. Right? So basically what this is saying, for every 1% adjustment in interest rates, you're going to see a 2-cent adjustment in the option contract. So let's say interest rates go from 3 to 4%. You've got a Rho of 0.02. That means that your option contract that was priced at $2.06 is going to go up to $2.08. Right? So an increase in interest rates, for example, are actually positive for the option contracts that you're holding. A decrease in interest rates is negative. What happens is if interest rates go, in this example, from 3 down to 2, you lose 1% in interest rates, you're going to lose 2 cents on your option price, which is reflecting the 0.020 Rho, which is being factored into the option pricing equation. So in summary, by learning the option Greeks as an investor, you're going to understand why an option is or is not moving in correlation with the underlying stock. You're going to be able to construct strategies to offset the impact of certain pricing variables such as volatility and time depreciation. For example, a great way to offset implied volatility is to use a debit spread, be a buyer and a seller at the same time. Main thing is that this understanding will help you better manage performance expectations, which ultimately will force you to become a much more effective risk manager when it comes to your own portfolio. So on that note, we'll open it up to questions, and I guess pass the mic over to Rose, and you're more than welcome to take over at this point.
Thanks very much, Jason. And as you said, you are welcome to type in your questions in the question panel as I do the closing remarks. So next steps is you can access our webinar recordings on our website, and also don't forget to fill out the survey that pops up after you exit today's session. And also mark your calendars. Tomorrow, November 23rd at 1 p.m. Eastern Time, we have the market guides joining us to present on risk management trading with stops and the 1% rule. And Montreal Exchange is back with us on Tuesday, December 20th at 1 p.m. Eastern Time to present on options trading and volatility. We also welcome you to sign up for other webinars under the seminar and webinar calendar on the Learn and Do More section of scotiaitrade.com. And again, past webinar recordings, including the Montreal Exchange Option Learning Series, can be located in the Webinars on Demand page. And with that, I want to thank Jason for sharing his insights, and thank you all for joining us. And I'm just going to check the question panel to see if anybody else has any questions. And also want to note that the handout is now available for you to download in the handouts panel. Okay, so we do have one question coming in from Ravi again. Ravi says, I think you implied this in the last slide, but it's better to trade in a way that minimizes the influence of these variables or maximizes the influence of these variables. Jason, I'll leave that to you.
Yeah, Ravi, absolutely. So the idea when you understand these pricing variables is that you can construct strategies that that will capitalize on the current conditions versus being sort of an unwilling passenger to the current conditions. So, for example, quite often we'll look at an opportunity. Let's say it's buying put options in a bearish market, and so the natural thing to happen in a bearish market is that implied volatility expands and options become pricey. And the risk that we run if we buy options in that market without being aware is that if those conditions change, then implied volatility contracts. But we don't know that that's going to happen necessarily. But if we understand that relative to the past, implied volatility is high, we can go in and use a bear put spread, and we essentially are able to calculate the impact of implied volatility out of the equation. That actually, in fact, also creates a little bit of a time hedge as well. So, there are opportunities where it makes perfect sense to just buy a call, or it makes perfect sense to just buy a put. But when we start to understand, what is actually, forcing these contracts to change in price, we can then make adjustments ourselves You know, that my sort of philosophy is there's so many things we can't control when we're trading these markets, that the more we can control, you know, the higher the probability of us being profitable. So understanding these pricing variables and then choosing strategies, you know, to mitigate or to capitalize on market conditions, you know, just add you know, just add value to what we're able to do. So yes, you are correct. It is better to, you know, trade in a way that takes all this into consideration, because you're going to make much more effective decisions.
Thanks, Jason. And Ravi, if you have any other questions or anybody else in the audience has any questions, feel free to type them in the question panel. So it looks like we don't have any more questions, but if you can't think of them, you are welcome to submit them to education@scotiaitrade.com, and I would be happy to forward them to Jason. Thank you all for joining us again, and thanks, Jason, for presenting a wonderful topic today. Thanks, everyone. Have a great day.
Thanks, everyone.